Doris. I'm here to show you about my stock account. Today, my stock account has made a loss of $3,664. The S&P hit our new 13-month high for the market focused on the Fed meeting. And the Fed surveys stated that inflation expectations hit a 2-year low in the next year, while the wage rise expectations fall. So first, let's take a look at my account. Today, my account has SQQQ made a loss of 5.03%, dropping to $20.69, and United Natural Gas made a gain of 0.32% in the post-market. Right now, the net asset of my account is $70,515.71. Today, the market generally closed higher, leading with the tech industries showing the gain. Dow Jones Industrial Average closed up 0.56%, Nasdaq Composite closed up 1.53%, and S&P 500 closed up 0.93% to 4,338.93. U.S. stocks closed higher on Monday, led by technology stocks, and traders expect the Fed to pause in raising interest rates. Monday extended last week's rally, with the S&P 500 rising as high as 4,340.13, the highest since April 2022. Investors are hopeful that the U.S. economy will avoid a sharp slowdown, seeing easing inflationary pressures will allow the Fed to suspend its monetary tightening cycle. The VIX is now trading at 14.4 points, near its lowest level since 2020. Technology stocks extended their gains, with Tesla rising for the 12th straight session, the longest winning streak on record. Apple closed up 1.56%, an all-time high. Goldman Sachs raises year-end forecast for the S&P 500 to 4,500, saying the rally would be extended beyond tech stocks. Famous Big Short Bank of America strategist Savita Subramanian said in a report that the bear market has officially ended. There is a room for further rebound in the future, but the market optimism will be tested in the next few days. The Fed meeting started Tuesday, released the results on Wednesday. Investors will receive the latest consumer price index report on Tuesday. Economists surveyed by Dow Jones on average expect 0.1% month-on-month and 4% year-on-year. Tuesday's CPI inflation data could help reinforce the idea that inflation is fading. Economists now expect the consumer price to show inflation gains, falling to 4% in May. Markets already expect the Fed to skip a rate hike at this week's meeting. Traders at CME's Fed Watch tool show a 74% chance that the Fed will not raise interest rates this week. But markets expect the Fed officials to stress commitments to control inflationary and raising rates for the last time at the FOMC meeting in July, then remain unchanged for the rest of the year. Certuity Company co-chief investment officer Dylan Kramer said the central bank will eventually decide to skip a rate hike in June, but that the Fed's overall rate hike process may not be complete. I think the week will be one of the biggest moments in the stock market, because if the Fed admits that it has made progress in controlling inflation, it'll pause in June and may even continue in July. I think this will give the green light to some sectors, though they will eventually be heavily pursued. But some analysts say that, for granted, traders should not take anything from recent actions by many central banks. European Central Bank will announce its interest rate decision on Thursday, and that the Bank of Japan will announce the outcome of its policy meeting on Friday. Markets now expect the former to raise interest rates by another 25 basis points, while the latter is expected to keep rates unchanged. The New York Fed's monthly survey of consumer expectations for May, released on Monday, showed respondents' inflation expectations for a year fell 0.3% points month-on-month to 4.1%, the lowest since May 2021. Respondents' inflation expectations for the next 3 years rose 0.1 percentage points to 3% from 2.9%, and from the 5-year rose nearly 0.1 percentage points month-on-month to 22.7%. According to a New York Fed's monthly survey of consumer expectations, respondents at the same time, however, inflation expectations for the next 3 years rose 0.1% to 3%. In May 2021, respondents' inflation expectations of 4% a year ago rose sharply and approached 7% in mid-2022. Consumer inflation expectations in the coming year in May were roughly in line with the market expectations. While the figure is still well above the Fed's 2% target, the overall trend remains slower. The main factors contributing to the decline in short-term inflation expectations are some adverse factors caused by COVID-19, such as the imbalance between supply and demand of commodities and the supply chain congestion, which are further easing. Rising wages are partly driving up inflation. However, survey shows that respondents' expectations of rising wages are weakening. Respondents expect wages gains to fall to 2.8% year-on-year, down 0.2 percentage points month-on-month, the first decline in 5 months and falling to its level since September 2021. Respondents with no higher education expected the biggest drop in wage growth. The survey also reflects the U.S. labor market. Respondents expected possible unemployment to fall 1.3% to 10.9% next year, the lowest since April 2022 and close to the lowest since the statistics began. The inflation likelihood of unemployment also fell 0.5% month-on-month to 19.1%. Respondents also said it will be easier to find a new job if they lost their current position. The survey also shows that households overall remain solid, expecting spending to rise 5.6% next year, up 0.4% percentage points from April by below average of 6.7% over the past 12 months. Still, a larger percentage of families say they are financially worse than than they were a year ago. Households' expectations for future finances continue to deteriorate, with fewer respondents saying they expect better in a year, while those say slightly or worse increased from 22.2% to 23.5% respectively, from 5.5% to 7.2%. More respondents saying getting a loan is harder than before, while more households expect credit conditions to tighten in a year. 11.32% of respondents expect failure to repay the minimum debt in the next 3 months, compared with 10.6% last month. On the other hand, despite a return to around 7%, respondents still expect the U.S. house prices to continue to rise, with the house prices expect to rise from 2.52% to 2.64%, the highest reading since July 2022. Those with household incomes of more than 100,000 expected the biggest rate of house prices to rise. By category, respondents expect gasoline prices to rise 5.07% in a year, food prices to rise 5.39%, medical expenses 9.18%, college education prices 7.12%, and rental prices 9.13%. It is worth noting that most categories of inflation expectations fell slightly from the previous months. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.